Hello and welcome to Advanced Bookkeeping Practice Assessments. This is the Osborne Practice Assessment 2 in the Tutor Zone. That's what we're going to go through today. So what we're going to go and see, we're going to see practice assessment undertaken in real time. You will see with that is you'll see all the workings that go along with it. So not just the answers and as a revision for the thing, but the actual exam technique. What working should be done with each exam, with each question, how they should be laid out, the use of T accounts, the use of timelines as well. Also, as well, what you'll see is where an error has appeared, because in the fifth task of this exam, I make an error. I get a transposition error incorrectly, and then how I use highlighter pens. You would use them there to go back and correct your errors and tick things off as we're going through. And it controls all the level of stress as we're happening. So, why do we use then this level of workings? Well, you've got a computer-based exam, and that really does sort of lack a bit of accessibility. So this approach really sort of overcomes that. And normally, in the good old days, you'd have it in paper, and you could put notes on the paper, and you could highlight and what have you. Well, this approach sort of gives you the same advantages of that approach really. It allows us to check our work, as I highlighted, and we got some errors or an error that I put in there. It will highlight that, and then we sort of the approach and the working spit out the error and will fix it for us as well. So when you get, this is what your tutor means by checking your work. Applying technique that it provides an answer about whether you're right or wrong. It's not a question of redoing the question all from scratch and doing it again and again and again and coming up with different answers and then just see which one actually was, whether you got lucky or not. Now this is actually how you check your questions. And this is going to counter stress as well. You'll see as we're going through, we're sort of doing things as we're going along. It just makes us, we're getting in, we can see the marks counting up as we're having, it makes a much happier experience for the exam. In terms of time, you'll see in terms of my workings that they're all laid out with T accounts and what have you, so it might take a little bit longer to do it first time, but it will be 100% correct first time. All alternatively, the errors will come out, so we're all that redoing the questions or just doing them again time, which is really wasted, goes and is replaced by actually getting the answer right and then knowing which bits are wrong and correcting them. So it takes a little bit longer in terms of that, but it's more effective in terms of the time and the use of method. As you'll see as well with all my videos, I think that everything's a technique-based method within accountancy. You apply the technique and the number drops out. So that's the approach that we take. We don't answer the question straight away. In fact, to be quite honest, most of the time the examiner is trying to lure you into trying to answer the exam straight away. We just actually apply a technique to each of the individual questions and then the answers drop out, go through it. A lot less stressful from that point. It's much more accurate. It avoids all those sort of mistakes and the thinking sort of side of it, and it's way less stressful in terms of, especially when you get to things like the reconciliation questions and what have you. It's a far less stressful approach. So what are you going to see in terms of the questions? Well, we've got a fixed asset one in here, all termed as non-current assets by the AAT, but within the industry is called fixed assets really. And what these are, and the reason why I use fixed assets and why everybody else as well, is something that you can touch. Actually, they're fixed tangible assets, so something that you could touch. So you saw office equipment, cars, computers, land and buildings, that kind of thing. We'll have the standard fixed asset register question going on. We've got a disposal and we've got some depreciation calculations going on. So that'll be useful for that one. In fact, it's a decent spread of a question that this assessment covers all of those and different methods. We've got prepayments and accruements as well. Prepaid income and accrued income. Something I should refer to as deferred income within the sector, but we seem to be using prepaid income in the Osborne books, and accrued income and prepayments and expenditure of expenses. We've got a trial balance and extended trial balance questions. We've got a sales purchase ledger control reconciliation. I think it's a sales ledger one in this one in here. Osborne seem to like to do sales and purchase ledger reconciliations. BPP seem to like to have bank reconciliations within their questions. Covers both of them then by using both books. We've got an errors and suspense accounts calculation, and then finally we've got a big extended trial balance one. I actually make a little bit of a transposition error in here, and my trial balance doesn't balance initially, and then I get out my highlighter pens and you can see how I fix it. So I hope you enjoy it. You can have a go as you're going along with me as well. Should be able to do it in real time, see whether you can keep up and answer it faster than me. Good luck. Thanks for listening. Task 1. This task is about non-current assets. So non-current asset, another word for it, fixed assets, things that are going to be level of permanence like office equipment, computers, cars, etc. Okay, so we're working on the accounts of business owner and manual trading. No VAT. It's kind of them. Following the extract from a purchase invoice, we're going to have some kind of purchase invoice, which means we're going to have This is going to be let's flick over to the page. Okay, so we've got a fixed asset register, a non-current asset register question. So we're going to have some kind of purchase in here. We've got an invoice. And before we even look at the invoice, with an invoice, what you're going to see probably is the cost of the equipment, something to get it into situ, something like, or another little bit that gets added onto the piece of equipment. So something like a delivery charge, something like that. There, we'll have some other little bit, which is a little trick, which is sort of either a maintenance thing, or I don't know. Let's have some printer, and we'll have some printer cartridges, some kind of consumable that goes alongside it. That shouldn't be capitalised. That's a trick to try and get it to capitalise it in there. We'll see what we got. Okay, so HT cutter, whatever one of those things are. Let's just have a look at our register, what we're recording here. So we call them by these various things. So actually, it's a HT cutter that we would call it. HT cutter. Here's the delivery charge here that we expected. So the total cost is going to be that we're going to put in our fixed asset register. It's going to be 2795 plus 50, the delivery charge. Oh look, there we go. There's the maintenance contract. And yeah, I don't know. We could have gone for some HT cutter blades or something like that there, though. Instead of that, that's try and trick us. That doesn't go into our costs. There we go. And there's our net total. No VAT in there. So that's going to be our cost in our fixed asset register. Here. Actually, let's just drop that in now into our fixed asset register if we've got it here rather than sliding back. It'll be somewhere at the bottom, won't it? Here we go, like that. Okay, so we're going to have HT cutter in there. And we're going to have the cost of it, 2845. We may as well start dropping these things in now beforehand in any case. And it's going to be the cost of 2845. Let's just have a look at the way in which they do it. Okay, so the acquisition costs and there along those lines. And what have we done there? We have what was the date? 1st of April. So let's put the 1st of April in. This -0 is the approach that they take. Okay. Right, that's what we got so far. Acquisition has been made under a hire purchase agreement. Okay, so hire purchase agreement, so basically we make a whole series of payments and then the final payment gets transferred over to us. That's a hire purchase. HP. Okay, right. I'm going to use HP rather than it would have been some kind of drop down that we would have been picking up in the question. Right, so that's that. There we go. Okay. The following information relates to a sale of an item of office equipment no longer needed by the business. So we're going to dispose of something. So copy your Excel file. Let's have a look at copy your Excel file. So it's this thing up here. Okay. So we can always immediately, for disposing it, put in these two items in here, which will be a 0 for the. Well, actually, we'll see what the depreciation charge is. Could be one or two things from it. It could be based on monthly, or it could be 0 depreciation in the year of sale. We'll see what the answer is, what the question is there. And selling price £200. Okay. Oops. So we can put the disposal proceeds in nicely here. 200, and we've got a disposal date as well. Where's our disposal date? 30th of September 2000. So our disposal date going into here. 30th of September. Whatever it is that they decide to do. Okay, so anyway, we've got our dates in. They would have been drop down boxes anyway available to us or whatever we would have put in there. However, it's going to go in. What are you using? Well, let's just make that a little bit as it should be. 30th stroke 09 stroke -0. Okay. So that's got us a few marks before we even started. We're feeling a bit happier about the whole thing. Okay. So our XL5 sale. We've got a trading policy capitalising expenditure over 500. This was over 500, so we've capitalised it. Machinery is depreciated on a straight line on a 25% diminishing balance basis. Okay, so diminishing balance would be that times by 0.25 for that first year. So we know that that one's going to be that. Office equipment is depreciated over 5 years on a straight line basis, assuming no residual value. Okay, so that's just basically taking the historical cost. Then what we would have then is depreciation would be cost minus residual value, and it's either one of times by the rate, the depreciation rate, or alternatively divided by the useful economic life. So here we got 5 years as the useful economic life, here with 0 economic value, so basically we're just having a 20% figure, so 1 over 5, basically 20%. 1 divided by 5, which is 20%. Okay. Depreciation is calculated on an annual basis. Okay. Charging equal installments for each full month that the asset is owned in the year. Oh, right, so that's nice. We've got so here, instead of going straight to the 0, actually we will have some depreciation in this here. So we now need to sort of create our timelines. So we're going to create a timeline. When was our okay, for the year ended 31st of March, so we got April all the way through to March, like that. And it's -1 here. Okay, so we're going to record all the various items on our fixed asset register. So let's start with our opening bit with our HT cutter. We buy it here, at this point in here, 2845. So we buy it here, so we've had all 12 months, because we buy it on the first of the month, so we're going to have all 12 months, so it's going to be that's going to be the full amount that goes in there. Let's see what 2 decimal places, so we do go with those 2 decimal places in here. So let's do our depreciation of that purchase first. Our depreciation charge in that year is going to be 711.25 here, and our carrying amount therefore is going to be equal to 2845 minus this 711.25. That's the first. .25. Let's try and get this right. Okay, right, here we go. Insert a little shape here. There's our carrying amount. Here, 2133.75. Right. Okay, that's that first one done. Now we're going to do right. Let's just go back and just check it. What was our machinery is depreciated 25% on reducing balance. So this is machinery here, 25% reducing balance. So we take this carrying value here of the previous year and we times that by 25%. 1575 times by 0.25. So we got here then our depreciation in the year on our diminishing balance, also known as reducing balance, is 3993.5. So it's just 7. Oh, hang on a second. 0.75, sorry. 0.75. Okay. And then also as well, one way to just check this, 1575 times by 0.75. Is that, see that didn't come out as the same figure. So okay, so that would be our carrying figure. So it's always useful to calculate both of them in terms of what should it be based on the carrying value, and then what should it be of the depreciation charge for the year minus the carrying value previously, and that will just give you a little check in terms of checking your work, trying to get this right. So there we go, that's the answer for that one here, and that has cleared off our machinery. Let's see what goes on. Office equipment was straight line basis over 5 years. So remember 5 years was 20% with no residual value. So 20%. Yeah, so we're now just going to go through our office equipment. Now this was then, let's go back, it was based on the full year, each full month the assets owned. So when did we sell it? We sold it on the 30th of September, so the end of September. So we owned it October, November, December, January, February, March. Yeah, so with our fingers we calculate that, and that's 6 months. So we've got 6 months of this copier is going to be charged, and it's going to have a 20% charge on straight line and straight line is based on the historical cost. So, and which one was it? It's this one here, isn't it? So we're going to go historical cost was 750, and it should have 20%, and also then it's going to be half that. Okay, so that's going to be equal to 750 times by 0.2 times by 0.5. £75 worth of depreciation charge. And there we go. Okay, the carrying amount is 0 because we then dispose of it. So let's just insert our disposal proceeds as well. Also, we put those in already. We've done our disposal proceeds and our funding method. There we go. That's that one done. And then we got this one here, and that we just need to just make sure that we don't do anything silly like this could have been part of the year. So let's just check. Right, no, it will be equals 1200 times by 0.2. That's 240. There. So that was a little bit sneaky. You see, you could have tried to shortcut this and just drag that down into there, but that was only for part of the year's worth of depreciation. Little trick there that has been put in place to see whether you try and be faster on that one. And then we would have 1140 minus 240. That's 900. Okay. Is that 900 there? And that then is our fixed asset register sorted. Let's now go through in here. Now the value of non-current assets is shown in the at there. Right, so we're going to have at there is going to be at their historical cost or their original cost or whatever it is we want to go call it in there. We'll see what they decide to call it in here. Depreciation charges are, that's going to be some kind of debited. Right, so let's have a look what we got available to us. Historical costs are shown in they're not shown in the statement of profit and loss. Statement of financial position will be there. Statement of profit and loss, also known as statement of financial performance. So the performance in the year, that's not there though. This is statement of financial position, also known as a balance sheet. It places that our assets, liabilities, and our liabilities to shareholders are all shown. So, statement of financial position at there, and then it would be original. All right, now the value of non-current assets is shown within there at there. Now, there'd be two positions here. This is a little bit tricky actually, because what you would see is there would be two things here. We would have our original cost as one account, so cost, but we would also have as well as our accumulated depreciation. Our accumulated depreciation in here. Let's just go through it now. It's strange they haven't put in market value in there because that would be a little bit of a trick. So original cost here, yes, is here, but we would also have this accumulated depreciation, which we're reducing that. So actually it would be a carrying amount. Okay. So they showed a carrying amount within the statement of financial position, even though there would be two accounts. So if it was in the trial balance, let's say, we would have a cost and we'd have the accumulated depreciation. In the statement of financial position, when we stick them together and we show them, then we would have it would be a carrying amount, and depreciation charges are debited because they're an expense. And that is a reduction in the value to shareholders, and therefore a reduction in the value to shareholders, the liability to shareholders, and therefore that would be a debit. If I can find B on my computer, there we go, debited. Right, so that is question 1 done. Task 2. This task is about accounting for non-current assets, so it's ledger accounting for non-current assets. Okay, so we're in the ledger, so we're in the general ledger here probably. For non-current assets, in other words, fixed assets, okay, you're working on the accounting records of the business ended the 31st of March 2016. VAT can be ignored, okay, know that. And we've got our timeline, which we'll set up to see whether that's relevant to us in a minute. Okay, and -6. I don't know why we can't just use normal years in this world, but never mind. A new vehicle has been acquired, yippee. Right, the cost excluding VAT was £12,000 and paid from the bank. So let's set up our T accounts. Here. And let's just go through through them all. What you'll see in this type of question is, let's say, it probably take up 5 or 6 various accounts within the general ledger. It'll ask you to do 3 of them, something like that then in the question. And really what it's trying to do is trying to just trick you. Will you go straight to trying to just do those, answer the question, or will you actually then do the whole thing and make sure that your work is correct? So we got VAT, we got vehicles cost, and we'll have vehicles accumulated depreciation. Vehicles. Terrible spelling up here by me there. Cost. Right, so we'll have those ones there. And so the first thing we're going to go do then is we're going to go credit the bank 12,000, and we'll go debit vehicles at cost 12,000. Right, the residual value is expected to be 4,000. Okay, so we're setting up for some kind of straight line depreciation calculation here. The depreciation policy is that, yep, there we go, straight line over 4 years. Right, so the depreciation each year is going to be cost minus residual value, okay, divided by useful economic life in this case. Useful life. So that's what we're going to see in terms of our depreciation calculation. So we've got the residual value here is going to be £4,000. Depreciation straight line over 4 years. So our depreciation each year is going to be equal to 12,000 minus 4,000, our residual value. Okay, 8,000 spread over 4 years, divided by 4, so £2,000 a year for each full year. Let's see what they do, whether they require. It hasn't really given us a purchase date, so that's going to be that. Depreciation has already been accounted for existing vehicles. Make entries to the account for the purchase of a new vehicle, the depreciation of the new vehicle. So the depreciation is going to be depreciation charges in the P&L account. Charges, and that's going to be debit 4,000 there, and it's going to be credit 4,000 for the accumulated depreciation. Okay, on each account should clearly show the balance carried down and transferred to the statement of profit and loss as according. Okay. Right, so what this is going to do then, let's now go through here. Vehicles at cost, then no, we can slide that down to there. We've got our balance brought down. Balance brought down here. We say given us at £64,000. Okay, so we got that. There though, so let's see what the option is here. This would be bank. Yep, we purchased it from the bank. The alternative one here, so there's our bank one there though, and then that's it for that one. That's going to be balance carried down, which is going to be 76,000. Total the figures up at the bottom. There we go, and that one there then is cleared, and that is that one there. Okay, vehicles accumulative depreciation. So accumulative depreciation, that was the charge and the item there though. So we're going to balance brought down. Oh, what we will have to see here though as well, it's going to be interesting, is balance brought down is here, is 24,000. Right. Now we've got this item in here, which is going to be one of them, but see how we've already got this thing here as well. So what we've got then is, let's see what we've got here, because we should have depreciation charge isn't going to be 4,000, it's going to be 2,000, isn't it? Here, what does it say? Let's just check and see whether we've been given another figure. We got, what should it say? Depreciation. Oh, depreciation has already been entered into the accounts for existing vehicles. So we're looking for that, and we're trying to see. So we actually don't need to do another calculation. We couldn't have done that in this case because we don't have the residual values of each of the other things there. If it was said there was no residual value and calculate it, then we could have tried to do that based on this this balance brought down here. But we don't have that. So what we're going to have is we're going to have the depreciation charge for the year. Sorry. So depreciation charge. Where are we in here? It's going to be depreciation charges. Yep, this one here. There's got an option there, and that's going to be the amount. that £2,000 that we calculated over here. So if we want to redo the calculation, 12,000 minus the residual value of 4,000, put that in brackets, there though, and then multiply that by the or divided by the 4 years. We'll get some Excel practicing whilst we're doing it if you want to. So there's our depreciation charges. Okay, into that one, and into this one here, that's the credit in the cumulative depreciation, and we'll just balance carried down, because this does go in the statement of financial position, which is going to be those two together, and we'll close that off. There we go. Okay, so that's that one. And then here we have our credit of the depreciation charge. So here we would have the vehicles cumulative depreciation. Have we got somewhere? What have we got? Vehicles cumulative depreciation. That was quite correct, wasn't it? And that will be the other side, the debit of that, which is the expenses. Now this one is going to be moved into the profit and loss account. So we're going to look for there. What have we got? We've got a statement of profit and loss. So we close that down with this by transferring it to the statement of profit and loss. And we'll close that down with £2,000 there. And then we'll add that up again. And that then is that account sorted. So that's the cumulative one there though. Let's see what the third one is that they do. Well, they probably might give us a bank one, let's say. You see one up the page. Depreciation charges. That was depreciation charge. Oh, sorry. That's it. There's the cumulative depreciation. There's the depreciation charge, and there's the vehicle at cost. Would have been a bit more interesting if they would have put VAT in there, and we'll drop one of these ones out, let's say, and just put the VAT one in, or the bit, or the bank one, to try and see that the trick is a little bit in there. But there's the fourth T account in this one here with our two journals there. So journal 1, that one there, and journal 2 being that there. Quite simple actually, that question compared to the one. Right, so that's the first part of task 2. Let's see what's in B. The business sold an item of machinery which originally cost £6,000. So let's just go through in here. Now the easiest way to do this again is to set up T accounts beforehand. We're going to have some kind of profit or loss and disposal, and we just want to sort of, rather than trying to think about this, set your T accounts up like this, and the answer will drop out. Okay, so we're going to have, what is it, machinery cost. And here, originally cost £6,000, so there's our £6,000 of what it was originally at there though. And we have machinery depreciation. And so far, 3 years of depreciation has been charged at 20% diminishing balance. Okay, so it'll be first of all is 6,000 times by 0.2. That was the first thing. Then what we then do is we've got diminishing balance, so we would have the carrying value was 4,800. So the next year it's going to be 4,800 times by 0.2. Was that depreciation there? And what we got, 3 years, have we? So what was 4,800? Carrying value after the 960 was removed. So the carrying value was 3840. So we got equals 3840 times by 0.2. See how by doing it in this nice T account method, much neater. And as a little check as well, let's just go and go 6,000 times by 0.8 times by 0.8 times by 0.8. That should be the value. Okay, and let's do equals 6,000 minus the 3 depreciation charges that we've charged. Right, so there we go. We've got the same carrying value as we should have. Right, so we know that we're right there. Proceeds of the sale, so let's go bank, and then we got disposals. Okay, now that would be what it would be called there though. I'm going to make it a bit easier. I'm going to go profit stroke loss on disposal, and by using this word profit or loss, you're going to notice that this is going to be the thing that's going to be transferred to the statement of financial performance, or the statement of profit and loss account, however we want to call it. So we bought proceeds of the sale with £3,000. Debit, bank, disposals, and we go on credit the profit and loss and disposals account, 3,000 bank as a description. And then what we're going to do now is we're going to transfer this machinery cost. So we're going to go disposals, credit the machinery cost, and we'll have debit machinery cost 6,000. And then this machinery depreciation, we're going to go debit all of that cumulative depreciation into the disposals, and we will go credit the disposal account with the cumulative depreciation, whatever it is called. Right, now the difference between the two lines is on this side in here, so it is equal to that minus that minus that. And so because our the carrying value was £3,072, and we only received £3,000 for it, so we made a loss. Loss on disposal. There. But what that is really going to be called is that's going to be the transfer to the statement of profit and loss account. And so we'll open up all these descriptions here. Now then, right, complete the disposals account to include the transfer of any profit and include the transfer to the profit and loss account, and let's close down that account here. And that is that really? That's quite an easy question, but what you can see is that we didn't actually really think about that. All we did was just drop in our T accounts and made it all quite straightforward and simple, so that was quite nice. Right, C. The owner of a business is considering using a hire purchase to fund a new vehicle for use in the business. However, the owner is unsure of what is meant by hire purchase and asks you for an explanation. So basically, it's a whole series of payments, and the last payment you transfer ownership. So, a medium-term agreement where a finance company funds an asset and a business makes installments to buy it. That sounds like a good one. That could be it. Let's have a look. A medium-term agreement under which the lessee has the use of the assets owned by the finance company, but there's no transfer at the end of that one, so that one's not going to be correct. Can't be that one. That sounds like more like a finance lease, where actually ownership or transfer is not done it. And what you can see is there's a medium-term agreement as well, just slightly drifting us into the idea of this thing perhaps not being the useful covering the useful economic life. Whereas actually we've got this final instalment to buy it, which is making a hire purchase. Medium-term agreement in which the bank or finance company lends funds to a business, that's a loan. That wouldn't be that. No, so it's not that one. That would just be a loan. We bought it. We bought title to it straight away. And then we've got a loan to do it. A short-term facility. If we're seeing short-term, we're having rentals as an idea of thinking of operating lease going on here, which allows the business to overdraw its bank. That's a bank overdraft account, and usually reviewed at the end of each year. That's a bank overdraft. That's just, and if you ever heard me say that this is the fish option, when I trained, you used to have multiple choice questions as the starter to the exams. Really, you had a few that just sort of got you into it, and it used to always go sensible option, but probably wasn't the answer. Sensible option probably wasn't the answer, but was quite close to it. The answer, and then the last one, which was just fish. It was just total nonsense, really, and garbage. So this is total nonsense and garbage, which eventually they might just put D as a proper answer somewhere, but this is a garbage answer. That's a bank overdraft. So this one is it. The answer is A, and that is a hire purchase agreement. The difference between the hire purchase agreement and this one here, and the finance lease, really. So this is saying medium term, which is trying to sort of suggest that this is covering perhaps the economic life here. This is short term, suggesting that it's not really either medium or long term in here. You have to know what the useful economic life is. Here, the lessee is owning the company even after the payments are completed. It gets the asset back. That's what's known as a finance lease. Here, the company making the lease payments owns it at the end with the final payment, and that's the hire purchase. Right, so that's the end of task 2. Task 3. This task is about ledger accounting. So we have some double entry bookkeeping going on here, including accruals and prepayments. Alright, so we're going to use we're going to use a lot of timelines in this one. Enter the figure in the table below, or for the appropriate trial balance columns. Do not enter the zeros and use columns. Do not enter extract from trial balance. This is just simply putting figures into the right place. So prepaid income. Okay, so a company's, one of our customers has prepaid their income to us, what's also known as well as deferred income. They've paid it to us in advance, so payment in advance for services that are going to happen in the year after. That's going to be a liability, so that's going to be a credit. Okay, a bank overdraft is going to be a liability to the bank, so that's going to be a credit. 1.5. Discounts allowed, so the sale, the initial sale, is a credit. Okay, so that would have been over here, the sale. But the discounts allowed is going to be a reduction in that sale, so a reduction in things that's be a debit. So what it is basically it's a reduction in the liability to shareholders, and because the liability to shareholders has been reduced, then it's a debit. Yeah. An allowance for doubtful debts. So basically we have our debts, which will be a debit because that will be an asset. The allowance for doubtful debts is a reduction in that asset, so a reduction in the asset is a credit. So that will be how our figures look for that one. So that's the open bit of task A. Nice. And now let's get on to task B, shall we? Okay. You're working on the accounting records for a business ended 31st of March 2014. And remember, we've already been told that this is prepayments and accruals land. So we're going to have our timeline up here, and we're going to lay that out with 0.4 there. Right. On this task in normal VAT, we're going to have something here which is going to probably say it's going to reverse in journal. So an entry is made into income expenditure on an opposite entry into the relevant asset or liability accounts. In the following period, this entry is reversed. So what this statement here is saying that the policy for this company is to undertake what's known as reversing journals. So at the end of March 2003 or whatever it was, X3. We can't just use proper years? I do not know. So at the end of this one in here, some accruals and prepayments are made, what have it, at the end of this point here. The following day, they're reversed out. We'll have some kind of question showing what the balance is probably of a particular ledger when we reverse it out. So we have the following information. Balance on the general administration account at the beginning of the year. So let's now start here. Let's produce our T accounts and start to drop them in. You really do not want to try and do these questions without T accounts and without timelines, as you will make life a lot harder for yourself. So we've got a general administration account, and the balance on the general administration account is 550, which represents a payment in advance for board-based. So actually, what we would have here. So we had a prepayment. So we went at the start of the year, at the end of the year, and at the end of the previous year, we had a prepayment of that. Then what we did on the first day, we reversed it out. So we went credit, prepayments 550, debit, general admin 550, like that. So that's what happened here, and that's what this note is sort of saying in here. The cash book for the year shows payments for administration, so let's put bank in here. The cash book for the year shows credit 2200. So 12,200 for administration expenses of that. So 12 there. So we've gone there. Now credit bank, debit our general admin account, and the administration's account has been adjusted for a bill received after the year end. The administration account has been adjusted for a bill received after the year end for general expenses relating to the month of March. So it was a bill was received here. 890. It actually related to here. There. So we pulled that back by going credit accruals 890, and we debited that figure there. So we would have debited it because the other one was in the bank account. That was that. So we've gone debit, that one there, accrual. So we opened up with the prepayment. Then we had our bank's payments during the year, and then we've had an end accrual. Okay, complete the following statement by selecting one of the options from each account and calculating the required figure. On the 31st of March, the administration accounts shows a debit entry for accrued expenses of, it will be of, what was it? It was 890, wasn't it? So a debit there of 890. Okay, well that was quite straightforward. Expected this to be a little bit harder, to be honest, but there we go, we got lucky here. So debit and for it's just accrued expenses, and it will be that amount there, 890. I suppose the trick here was it sort of whirled you around to a prepayment at the start. You might have got tricked to the idea that, well, we're going to go and carry on with the prepayment and carry on then. That's that. Right, okay. What else? Cool, calculate the administration expense for the year. Okay, so let's go back and complete our account. So we got the transfer to the statement of profit and loss account, P&L, okay, which is going to be all of those items there. Close down account, and it's 13640. Now what you'll notice here is you notice how this tier count is all nicely set out, so the figures just drop out by doing it properly. You could have tried to calculate your way through and done some kind of mental arithmetic and started adding up in columns and whatever, and just generally chasing your tail in a horrible way, but that would make life much harder than it needs to be. Right, okay. Cash book for the year shows payments. Oh, we're still holding, aren't we, with the year? Yeah, let's stay with this particular year then. Actually, we can just copy this across here, and I'm going to delete out all the items we put in so far. Take out this colour here, and this lot here. Okay, so let's start again and see what we've got for this one here. The cash book shows payments for advertising expenses. We've got advertising. And we got our bank. We've spent, so we went credit bank 9455, debit advertising 9455. Okay. Right. Update the advertising accounts for this year. Clearly the balance we carried down. Alright, okay, so we've got an accrued expenses as well, reversal. So reversal, 810 there. There's our expenditure here. So what happened was we had an accrual here, which would have been, we went debit the accrual account on the first day, and we went credit the advertising account in the reversal, right? So that's that, and then we'll put this as the statement. What we got in here is our options in here. So we had an accrual expenses. We've now got our bank there as one of them there. So that was that one, and then we're going to put which one we're going to use. Statement of profit loss account. Loss, and that's going to be that bank figure minus that accruals. Yeah, close down our account. And so that there is the answer for this one here. Right, you now find out that there is a bill of 1,650 for the website for 2 months ended the 31st of April. So 2 months ended the 31st of April of 1650. Okay, for these 2 months here. So half in that month and half in that month. This is outside the year end. We're not interested in that. This is inside the year end. So we've got an accrual here of 8650. So what we should have then is our accrual. We should be credit 825, sorry, and we're going to debit this then in here 825 there. Right. It's not included. Complete the following statements, calculating required figure for each box. Adjusting for this will increase the total advertising expenses figure transferred to the profit and loss account, because what we would now have is, let's take this out here. Actually, let's just put the accrual in a sensible place. 85 there, which now means that that is going to be that plus that minus that there. Close down our account again. That's what it should look like. See how it, and that's gone up there. So that will be an increase. Insert our shape. Increase. So we'll increase. Total, right. The adjustment is 85. Advertising channel will show as a debit in there. Will show as a debit in the statement of profit and loss account in the general ledger. Okay, so that is that answer there. Okay, pretty straightforward. A little bit more of this question, so let's see where we're up to now. Then, no, prepaid income shows. Right, so let's keep going with our. We can now just copy this across again. Clear out all of our colours and everything that we put in so far. Let's start again then. See what we've got now. You notice how I constantly come back to exactly the same technique all the time, and if you look at the other videos as well, exactly the same technique. So prepaid income. So we've got prepaid income. Prepaid income. As at the end of the 31st of March. Okay, so 5,000, sorry, credit at the end of 31st of March. This relates to advanced ticket sales. Ticket sales. Complete the following statements. The reversal of this accrual is a debit in the prepayment account and a credit in the ticket sales account. Yes, so a debit in the prepaid income account because we're reversing out that liability that we had, and a credit in the ticket sales account. Okay. Client asks you why you are adjusting this ticket sales account. Which of the following can you use as an explanation? Alright, okay, so let's now get down into which one we're going to have. Prepaid sales are relevant to the year ended 31st of March 2005. Well, they are, because they're actually in that thing there, so they are relevant to that following year. So that is an acceptable reason. Yes. And let's see where we're going. You assume the client, right, so if you see the words assumed in there, though, assume usually makes an ass out of you and me. So you assumed the client would want this as a way of reduces profits. Though, you know, that's just manipulation of the accounts. So that's a not acceptable reason. Let's see what the last one is. Advanced ticket sales can be recognised either in the current period or in the next period. No, they're not, because they're advanced ticket sales, so they're for the next period. So that would not be an acceptable reason either. So that would be how it would look. And that is the end of task 3. Task 4. This task is about accounting adjustments. We've got some form of adjustments in our extended trial balance. So no entries have been made for closing inventory for the year 31st of March. We have some kind of residual cost here. So let's just put our T accounts in before we start. Yeah. And we'll have closing inventory. Balance sheet, also closing or statement of financial position, whatever you want to call it, closing inventory, profit and loss account. Okay, closing inventory has been valued at 24150. So that will be what the cost of it was, plus any kind of absorption that we got. Including in this figure, some items costing 1030. Here's where we come with a point where it's not going to be worth as much, but it can only be sold for 750, so it's not actually worth that. So prudence, we go and we recognise our losses immediately, and we only recognise our profits when they're incurred. So the closing value of the stock, okay, what's that? 23870. There's our balance carried down. 238,870. Now balance carried down. Okay. Right. Record this adjustment in the extract from the trial balance on the next page, shown on the next page. Alright, okay, so on the next page we got here, so we got 2 in here. So statement of financial position is our asset, remember, so that will be 23870 there, 23870 there. Our stock represents an asset to the company, so it's going to go in the balance sheet on the statement of financial position as that. And let's go into our statement of profit and loss account, which is going to be the reduction in expenses, 23870 there. Okay, so we've done that. Make the following further adjustments in the extract from the extended trial balance. Alright, oh, so we've got some errors, have we? Oh, I don't know, well, actually, let's just see. We might have some let's just create some T accounts, and we'll also as well have our timeline, which we'll put together in a second. Any particular year that we're going to be given here? No, we aren't given a year. Right, so we'll see what happens. Right, a receipt for commission received of 550 is made into the bank. The correct entry was made into the bank account, but no other entries were made. So we've got commission received. So we went into the bank. In the bank we went debit bank account there 550. So we should have done credit commission received 550 there, but we haven't done that. Ignore VAT, so that's missing there. So we're going to have to set up some kind of suspense account that will be going on. Let's have a look and see what happened over here. Over the page we'll have a suspense account looking. There we have it. There it is. Credit of 3,800. In terms of checking our work, what we can do is, so we're going to credit commission received 550. So we're going to debit our suspense account there. Columns received and suspense. There's that error. Okay, let's see what else is happening here. Entries need to be made for an irrecoverable debt of £200. So sales ledger control account and irrecoverable debts. Notice how it was irrecoverable debts rather than doubtful debts. If it's irrecoverable, then we immediately wipe it out from our sales ledger control account. So our sales ledger control account is an asset. The reduction in that is going to be therefore a credit, and we will have that as an expense there. The figures from the columns in the purchase date have been totally correct as follows. So that's what there though, but it has been posted as this. So what happened? We posted the purchases incorrectly. So they've been posted, the purchase date has been totaled correctly. Posted it as that, right? Okay. So what happened was we posted the purchase ledger control account correctly as a total figure. We've totaled the VAT correctly, but this was totaled incorrectly in here. So we would reverse that out and put in what should be in there. So we went debit purchases 19500. So we're going to reverse that out 19500. Let's take this out here though, and then we're going to put in the correct figure. Sorry, debit 1950. Sorry, we went credit 1950 and we debited. No, we won't debit it. And then we're going to credit that out, and then we're going to debit our purchases in there 16250. That. So the net position. Actually, I think what it's going to probably require is yeah, this is going to be interesting to see whether. I suspect that what should happen in this one is we should technically really post it like that, and in the suspense account it should be going debit 19500 and 16250. That would be the correct thing with the correct audit trail. So that's how it should look. And I'll leave it like that. I wouldn't mind betting that the answer probably netted this off if it was checked. Right. So that's what we should have. Alright, so we're just going to take these across and post them. Right, so let's just drag these across to the next page. See where we're going from there. Okay, so we've posted that one then. Commission received, insert shape, commissions received, credit 550 here. Here, our irrecoverable, leave the suspense account to the end. Sales ledger control account got a 210 credit against it. And then we had that irrecoverable debts, didn't we, have £210 expense there. That one. So we cleared that, we cleared that, we got rid of that one as well, that one as well. We cleared that one as well, actually, because that was both sides of this thing. They're the same thing, just the opposite way around. Then we got our purchases here, which realistically it should be posted in the opposite direction. But what we'll do is, because we're in the adjustments column here, we'll net this. So we'll have a difference of them, which is going to be minus 16250. So if we were in the year, we would have adjusted that. Sorry, 19500 minus 16250 should be that one, shouldn't it? Shapes. So in year, it should have been reversed out, and then at the end of the year, we're going to have to go and adjust that one, so that's going to be a credit of that, 3250, and that is going to be a debit then in our suspense account here, and then we also had as well this one, there's a credit in our suspense account there. So those are our double entry bookkeeping sorted. And does this suspense account now balance? Let's change this so that it is 3250 here. What was its credit? Wasn't it 3250? No, 3250 debit, wasn't it? Yeah. And then does this now balance out to 0? In this question, the suspense account should balance to 0, and that's how you check your work. So yep, so that's correct. So that with that one answered. Right. On to C. The ledger is now ready to be closed off for the year end 31st of March 2001. Show the journal entry to close off the payroll expenses account. Right, so let's go and open up our payroll. Let's create the payroll one first here. So payroll. Alright, this is just going to be straightforward. So currently we're holding on to 76,422 as a debit balance. We will then, so we'll have that in there. So we're going to go credit the payroll account. Our options are payroll expenses. We're going to credit that with the amount. We'll credit that here, 76,422. Yeah, and what we're going to do is we're going to be debiting the statement of profit and loss. Let's see whether that's an option. There it is, statement of profit and loss, that one there. Statement of profit and loss with that 76422. That's just a nice T account question, really. You see here this payroll control was dropped in to try and sort of wind you up or trick you, really, and that's for a wages control question well, you would have seen that in level 2 bookkeeping controls in here. So that's that answer there. Select the appropriate narrative for the job journal. So I'm going to transfer. So transfer payroll expenses for the year end 30 March to the statement of profit and loss account. That sounds like a very good answer. Let's read what the rest of them are. Transfer of payroll expenses from the trial balance. Well, it's not really from the year ended 31st of March, but to where? So it's not that one. A is still better than that answer there. Transfer of payroll expenses for the year ended 31st of March to the statement of financial position. So statement of financial position is the balance sheet. In there though, the position for the shareholders at the end of the year, effectively their assets minus liabilities. So that's definitely not it. We go into the profit and loss account first, and then the profit and loss account goes into the balance sheet, so that wouldn't be going straight to there. Write off of payroll expenses. Well, that's remember we go back to that fish from there. The D seems to always be something stupid. Be careful on that one there though, because in the examiner, I think this is sort of a stylistic point from Osborne really. It seems to like, because if you go back here and previous questions, I think there was an A one again. It seems to like to sort of put the answer as A, and I'll see whether it'll try to like the confusion, then put some stupid answer at the last one there. Though the examiner's not going to follow that kind of pattern. That's ridiculous. Let's see what else we got in this question. Oh, we got another little bit of it. Let's see what we got. You are working on the year-end accounts. Well known. This can be some kind of professional ethics thing there though. A well-known employer in your area. A friend who works there tells you that she's heard a rumour that the business in financial difficulties. Oh, okay. She asks you if the rumour is true, so confidentiality. She's worrying about her future. This means some kind of familiarity threat to your confidentiality. How should you respond? Say you cannot talk about her situation, but offer a copy of the draft accounts of the business. That would be a breach of confidentiality, so definitely not that one. Though. Say that anything you tell her about the business must not be shared with anybody else. That's just breach our confidentiality. That's terrible. Say that you have a duty of confidentiality and control there. That's going to be the correct answer. Let's see what D is. Say that you have a duty of professional competence and not well enough to qualify. So that's just again the fish answer that seems to be constantly put in by Osborne. Yeah. Okay. I don't even know why we bother with a D in an Osborne question, because they seem to always just be total rubbish. Right, so it is C there, and that is task 4 done. Task 5. This task is about period end routines using accounting records and extended trial balance. Alright, so we've got an extended trial balance question. We're going to have to load T accounts. Let's just put them in here, see what we've got. Might have some timelines as well coming on with some prepayments. Let's see what happens here. Right, let's have a read through. You're preparing to reconcile the. Alright, so we've got a sales ledger control account here. You're preparing to reconcile the sales ledger control account to the sales ledger. So we're going to have we've got our reconciliation questions in here. BPP like to do sales ledger control. BP like to do bank rec ones. Osborne seems to like to do sales ledger, purchase ledger, reconciliation ones. Sales ledger control account. Just interesting to see the styles between both providers, really, isn't it? And the sales ledger. Okay, so balance on the sales ledger control account is 22 debit 223636, and the total bonds on the sales ledger debit 22577. Right, okay. And the sales ledger can compare to the sales ledger control account, and the following differences identified. The total on the sales day return book has been added by 100. Right, so on the sales returns day book, so on the sales returns one, though, sales returns we would have gone, all that's going to do, it doesn't say anything, all that's going to do then is we would have gone debit sales ledger control account 100, credit sales ledger control account 100 more than we should have done, so that's not going to make any blind bit of difference to the whole situation. Really in here, let's just see what we're supposed to do. So what few adjustments was made to the sales ledger control account? Right, so we should then go sales returns. So we could adjust this, and really what we should have done was take the whole lot out and then done it incorrectly again. So we're going to we've over debited it by 100. So we're going credit sales returns account, debit sales ledger control account 100. There, so let's put that in. Sometimes it's like what are the three things that are going to do the difference. So we're going to have debit in here, and we will have, just because I'm not going to go and find a tick in Windings, and the amount's going to be 100, and it's going to be number 1. So that one's going to go in. The credit sale of 250, and when it starts to say names, we're going to go error of commission here, but let's go 250 to highly limited is debited to the sales ledger account of heightened limited. That's not going to hit the sales ledger control account, it's going to be an adjustment in the sales ledger, it's an error of commission. A receipt of £352 has been credited to the sales ledger account of Anthony Mark rather than sales ledger of Mark Anthony, so we've just got the same error of commission going on here. Makes no difference. A BACS transfer received from a credit customer was for £650, but the amount but that amount, assuming credit comes from £650, but that should have been received. What should have been received was 560. So what? They just made an error, and all right, we've gone. Bank, we've received 650. It should have been, and we've gone credit 650 over here. Whilst they should have gone 560, that's not what they did. They paid us 650. So what we actually have is will be one in the sales ledger, which will be minus 90. A credit of 90 within the sales ledger. So, but that's a so what. And so there, a set-up entry for 65. Okay, so let's now go into purchase ledger control account in here, and so we would have gone debit purchase ledger control account in here. 65 has been put in the sales ledger control account as 56. That. Okay, so what should have happened really is this should have been 65 instead of 56. So we would go credit 9. That's what we're going to go. Credit 9 there. So this will be £9 and it will be a credit. So number 5 is a 9 and it's going to be a credit rather than a debit. And the adjustment's number 5 then. 5. Okay, let's do the last one. The settlement cash discount of £75 allowed to trade receivables has been entered on the wrong side of the sales ledger control account. So let's go prompt payment discount. And that will be a debit because it's an expense to us. Effectively. So £75 in here. Nice. And so we should have gone debit the prompt payment discounts, credit the sales ledger control account. Instead we went debit it. Yeah. So what we'll have to do is we'll have to reverse that initial one out, that initial error out, and then put the right thing in. So it'll be 150 for this one. So number 6 will be 150 adjustment there though. Number 6 and the amount is going to be 150. And that there though was those two there, so it's going to be a credit as well. Now you can see that rather than thinking, we just put it into our T accounts, and the answers just dropped out for us. So that's why it's just a lot easier than it was, and that actually worked. So that is how our T accounts would look. That was the correct one there. Right, we would have a suspense account going on somewhere along here as well, which we corrected. Which of the following statements about the suspense account is false? Right, so we've got false, so things are going wrong here. It's used to record the difference in the trial balance columns. Well, no, that's definitely the correct position, so that's not right. Let's put them over here. That one's not right. Okay, it should have a balance of 0 when the relevant adjustments have been made. And it should have a balance of 0 when all. Yes, that would be correct, so that's not false either. It's used to record an error of omission. No, an error of omission simply wouldn't be in there. It wouldn't create an error in our trial balance. It wouldn't have hit either part of it, so that would be there though. It's often the result of errors of double entry bookkeeping. That one's correct. So the answer to this one is C. In here. Right, so that gets us through that one. There though. You have the following extended trial balance. The adjustments have already been correctly entered. Right, so we've got our correctly entered adjustments. Extend the figures into the statement of profit and loss and the statement of financial position. Do not enter zeros. There though. Complete the extended trial balance. And label entering figures and a label see below. So the label is going to be the profit and loss for the year. So we may as well just put that in now. Shall we? Profit and loss for the year. So that's what's going to go into there. What I'm going to do here is I will line these up here. So there, that, and we'll just put it actually into the right hand side of this. There, right. Just make sure that we get these lining up. And that should it'll just make it a lot faster going through. Okay, that will be the last one. Alright, okay, and we'll type in that profit and loss one just here. Profit and loss for the year. Now I'm going to give you two methods of doing it here. I'm going to give you the electronic method, and I'll give you the manual. Okay. So the electronic method has pluses and minuses, and the manual has debits and credits. So here we go through here. So allowance for doubtful debts minus 1450, and we adjustments there. So it'd be minus 1540 minus another 170 for the credit, and so that was going to be a credit of 1740 like that. And just doing it this method, make sure that you don't make a mistake and double up on your get the actual debits and credits the wrong way around. So the bank one was minus 2850, but then there was a debit of 200, which is a plus there, and that's going to be a minus 2650 there. Capital is going to be minus 35,000 and minus 35,000. Closing inventory. So closing inventory is going to be both. It'll be a 0 in the electronic one there though, and 18640 here and 18640 there, like that. Okay. Depreciation charges are a debit, which is positive 2490. Here 2490. Now irrecoverable debts 175. 175. In here, office equipment costs 20250 because it's a debit, positive 20250, and there's our debit there 20250. Like that. Our office equipment, we've got two credits here. Cumulative depreciation 6350 minus 2490. There, so there's our credit there. Okay, our office expenses, yep, equals to 83320, and then we've got a credit, so that we've minus that off from there. That's that. So that's going to add debit of that there. Opening inventory. So we started to slide out a little bit, haven't we? Let's just get these all back into order again, into line. Our opening inventory 15320, which is going to be a debit 15320. It's going to go into our statement of profit and loss. Our purchases, we've got plus 58930, and then we've also got another debit 230. So that is that one there. Our purchase ledger control account is a credit minus 6970 and 6970 there. Okay. Our sales is a credit minus 103450, and a credit there. Okay. Our sales ledger control account, start to slide a little bit out again. Our sales ledger control account is our debit 20720, debit 20720. Selling expenses is another debit there though, 25030 there, and then our suspense account here is credit, so minus 620, and we plus 050, and we minus 430. 0, excellent. And our VAT is a credit, so minus 1875, and the credit should be there. That. Okay. Adding that up there should go up to 0 in the electronic version. Oh, that means we made a mistake somewhere. And we can see that it's different. So let's go through here and check what's gone wrong. We got our error then in here. Let's just go through and check these ones off in here. And what we can see is we made an error there. Let's just get that right. Clear that there. And then in terms of the things that we got wrong in here. Now let's just get our highlight and pen, and we can just clear off those there. We cleared up that one there. That's that one. there, there. So this is where in an exam on your, you've done this on your workings, and now you get your highlighter pen out and you tick them off rather than just staring at them. We're happy with that one. Yeah, that's correct. 2 credits is correct. 17,650 is correct. 15,230, yep. 59,160, 970, okay. 10340, yep. 720, right. Okay. Okay, that one's not right, is it? We've missed off that one, right? Okay, so equals to 25,030 minus 380. Here, that one there. So we're still out. Here, suspense account there, and then our VAT position here. Okay, so this is interesting, isn't it? And let's just redo this as well to make sure this can bring in and everything. Alright, so we've brought everything across to the right hand side as well. We missed something. Let's put our statement of profit and loss. Let's just carry on, and then this figure will drop out, and hopefully when we're working out our errors. Statement of position in here. Right, allowance for doubtful debts. Well, that's the allowance, that's a reduction of the sales and control accounts. That's going to be a credit there in the statement of financial position. Allowance for doubtful debts, the adjustment is the expense within the profit and loss for the year. It's 117 to there. The bank is an asset, therefore that is going to be, in this case actually it's a liability. That's an overdraft. So we're going to be going into there. That's what we've done wrong. So here we got, this is a minus in here, so let's just take that out there, and that is a minus in there. Okay, now we're getting a bit closer. We're still 90 out, but we'll find it in a minute. Okay, capital is the initial opening capital from shareholders, so the liability to shareholders of £35,000. Closing inventory, so it's going to be a credit. The credit is in the statement of profit and loss account. It's the reduction in the expenditure, and the debit is the asset at the end of the year, what it represents. Our depreciation charge is goes into the statement of profit and loss account. Our irrecoverable debts in here is an expense in the profit and loss account. There. Okay, we've office equipment at cost, that's an asset, so that goes into our balance sheet, our statement of position as a debit there. Our office equipment accumulated depreciation is the reduction in the value of that asset. So that net of those two is the carrying amount in here. So the carrying amount in the electronic method, it nicely comes out as being at 11,410. Our office expenses is the expenses in the year, and that is that debit there. Our opening inventory goes to the statement of financial performance as the expense there. So if that was the closing stock here, there's the opening stock going into there. Our purchases is that figure there. Our purchase ledger control account is the liability to our suppliers, which is that one there. Our sales is the credit in the statement of profit and loss, which is that one there. And our sales ledger control account is the asset at the end of the year with our customers. Our selling expenses is in the statement of financial performance, and our VAT is the liability to HM Revenue Customs. The last thing then is going to be the profit and loss for the year, so let's go through and add all of that up there. We still know that this isn't quite correct yet. Let's see what the difference is between these two here, which will be on that side. So be a bit of profit in the year. Doesn't like that because that would be a circular reference in Excel. Let's just drop that back to there. Okay, so we're out here. We're still then though this £90 out here. And let's just see whether we've got some kind of transposition error going on in here. Let's just go through and just check these off again. Doing a proper exam technique really now. Right. Get through and just start ticking again. That one's right. Yeah, that's correct. That's correct. Correct. There. That one's there. That that there is a transposition error. So that should be 230 in here. Does that fix it for us? Yes, that's given us a 0 there. Balance our balance sheet there. So now we've got this right here. There's our profit and loss for the year. So it's a profit for the year because our credits are greater than our debits here. So we're going to go debit there and we're going to credit here in the statement of financial position. Let's now add all of that up. 29. And our balance sheet should hopefully balance. There we go. So that was that one. A bit long-winded to get there. That was quite useful. We saw an error in there and we worked out how to correct it really. By going through and just simply ticking and checking, and you notice how having it on a piece of paper like this and then putting your highlighter through allows you to sort of check it, and that's a way of doing it really. Probably would have actually been easier in the exam to have the computer and just sort of write it down and calculate as you're going along, but that was where we made this little error here where we had a slight transposition. Instead of putting 2-3, we put 3-2 in there. So that's the end of that question. Is that the end of the whole thing? Great, it was all going so wonderfully until the end, wasn't it? And still you can see how things worked out, but we got it all right in the end, and that's the important thing. Right, thanks for listening.